Hello, I'm Shirley. Today, I want to share a topic regarding to the financial health check when a company want to apply a bank loan. So recently, a lot of people come to look for me and asking me to help them to do a cross-check for their income statement and check whether they can apply the bank loan. So what are the key points for the bank officer when look at the cash flow or the income statement? Normally, there are 4 accounting points the bank will look at it to justify whether the company is healthy or profitable. First, positive net profit in an income statement. Most of the bank officer will look at the net profit at first glance and also want to make sure the company is consistently profitable over the past 3 years. Net profit margin ratio also more than 10%. A company generating net income indicate that it can be manage costs and operate efficiently. For example, ABC Restaurants and Berhad, their revenue is 2 million and net profit is 300,000 as at 31st December 2024. Net profit margin meaning net profit 300,000 divided by revenue 2 million. So it shows that the company net profit margin at 15%. So generally, if a company net profit is more than 10%, it's considered healthy for many industries. Second, strong current ratio in balance sheet. The current ratio is a key liquidity indicator that shows whether a company can pay off its short-term liability using its short-term asset. For example, ABC Restaurants and Berhad current asset is 1.2 million and current liability is 600,000. Current ratio meaning current asset divided by current liability is a healthy current ratio with 2.0. Why current ratio is important? From the current ratio, the bank officer will know whether the company is able to pay the bills on time. A healthy current ratio shows the company can cover salary, supplier rent, and etc. without relying on loans. Lender and bank will also see it as a sign of strong short-term solvency, reducing the loan default risk. A healthy current ratio shows the efficiency working capital management. It implies the company has a good balance between inventory, receivable, and payable. A company with cash cushion is in better position to negotiate credit terms with vendors. However, not all high current ratio are good. A very high ratio, especially more than 3.0, might indicate a company too much cash lying either overstock inventory and also slow moving receivable. Third, low debt to equity ratio in balance sheet. The low debt equity ratio measures a company's financial leverage, how much it is relying on borrow money, meaning the debt, compared to the owner funds, which is equity to finance its operation. For example, ABC Restaurants and Berhad total liability is 1 million, equity is 2 million. Debt to equity meaning total liability 1 million divided by shareholder equity 2 million. Debt to equity is 0.5, which is indicate a good financial balance. Normally, it's preferably less than 1.0 for SME company. Why it indicates a healthy company when less than 1.0? The company show a lower financial risk because it has more asset funded by the shareholder than by debt and also less pressure to meet a fixed repayment or interest. Bank and investor prefer lending to a company with a low debt to equity ratio as they are less likely to default. More equity means the company has built value, not just borrowing to grow. Investor also confidence at the company financial position with a low leverage signal, conservative financial management, and its resilience during downturns. For positive operating cash flow. Operating cash flow measures the actual cash generated from a company's core business operation excluding investing and financing activity. Operating cash flow meaning net profit plus non-cash expenses, example depreciation and amortization plus change in working capital. For example, ABC Restaurants and Berhad net profit is 300,000 plus depreciation 100,000
minus increase in receivable 50,000 plus increase in payable 40,000. So total operating cash flow is 390,000. The positive cash flow indicate the business is generate cash from operation. Why the positive operating cash flow is very important? Because it shows that the net profit is backed by actual cash, not just paper profit. Positive cash flow ensure the business can cover its daily expenses, can pay supplier and staff. The company isn't reliant on external loan to stay afloat. Normally, bank is favored with strong operating cash flow company because it show lower risk of default. From the 4 key accounting points to justify that the company is healthy and profitable, there are also exceptional cases if the ratio or index is lower than the benchmarks. A net profit margin below 10% can still be acceptable in several industries, especially those with high volume, low margin business model. Here are the 5 industries along with the reason. First, the retail, especially supermarket or FMCG goods. For example, grocery, hypermarket like Tesco or Giant. Typical net profit margin is 1 to 3%. Normally, these retails operate on thin margin but high volume, fast turnover of inventory and steady cash flow. Competitive pricing is essential, squeezing profit margin. Second, the transportation or logistics. For example, trucking, freight forwarding, shipping. Typical net profit margin is 2 to 6%. Normally, this industry with high operating costs like fuel, labor, and maintenance. Highly competitive with price wars and tight contracts. Economy of scale and long-term contract help sustain profits. Third, manufacturing industry, especially low-value goods. For example, plastic goods, garment, electronic assembly. Typical net profit margin is 3 to 8%. Normally, these company margins are tight due to commodity pricing and outsourcing. The business success comes from volume, efficiency, and process automation. Stable order often matter more than high margin. Fourth, construction and engineering. For example, infrastructure, property development, typical net profit margin is 5 to 8%. Their projects are capital intensive and often fixed price. Margin may appear low due to long project timelines and cost overruns. Cash flow and asset-based valuation are often more critical. Fifth, automotive dealership. For example, car sales, parts, and servicing. Typical net profit margin 2 to 5%. Car sales offer very low margin. Profit often comes from after-sales service. Financing, insurance, add-on, and servicing boost overall profitability. Conclusion, a company that consistently delivers profits, maintain liquidity, avoid excessive debt, and generate positive cash flow from operation is fundamentally strong, creditworthy, and well-positioned to support working capital loan. So these are the topics that I want to share today. I hope you can get more knowledge on this. Thank you for watching.